And happening now, Bank of Canada Governor Tiff Macklem is speaking about the central bank's decision. Let's listen in live.
With consumer spending expected to remain subdued through most of 2024, we've revised down our growth outlook. GDP growth is forecast to remain below 1% for the next several quarters before picking up in late 2024 and rising to 2.5% in 2025. Comme vous le savez, nous suivons de près les indicateurs de l'équilibre entre l'offre et la demande. En ce moment, ils ne vont pas tous dans le même sens. Selon les estimations de l'écart de production, l'équilibre serait déjà atteint. L'offre aurait même légèrement dépassé la demande. Selon les indicateurs du marché du travail, les fortes pénuries de travailleurs auraient beaucoup diminué, mais le marché serait encore plutôt tendu. Le nombre de postes vacants a baissé.
The number of vacant positions has dropped and is higher than normal. This creates a slight rise in the unemployment rate. Salary growth is strong, and it is between 4 and 5%.
What is pressures have eased more quickly than we forecast in July.
We are already seeing more evidence that tighter monetary policy is reducing price pressures for many goods and services. And with the economy already or soon to be in excess supply, more downward pressure on inflation should be in the pipeline. But our outlook for near-term inflation is higher. Let me explain. The effects of higher interest rates are most evident in the prices for durable goods like furniture and appliances that people often buy on credit. And these effects have also spread to many semi-durables, a category that includes things like clothing and footwear, as well as many services excluding shelter. Inflation in these categories is now running generally at or below 2%. Price increases for groceries, while still elevated at almost 6%, have also eased and are expected to moderate further. Despite this, we've revised up our outlook for inflation. Higher energy prices, structural pressures in our housing market, and stickiness in underlying inflation are all slowing the return to target. Higher global oil prices have driven up gasoline prices, and we now expect oil prices to remain higher than we assumed in July. Inflation in shelter services is running above 6%. Part of this is due to higher mortgage interest costs following increases in our own policy interest rate. But it also reflects higher rents and other housing costs, and these pressures are more related to the structural shortage of housing supply. Finally, near-term inflation expectations and wage growth remain elevated, and corporate pricing behavior is normalizing only slowly. All this is making underlying inflation more persistent. The combined impact of all these factors is that we now expect inflation to be about 3.5% through till about the middle of next year. As excess supply in the economy increases, inflation should ease further in 2024 and reach 2% in 2025. There are both upside and downside risks to this inflation forecast, and the future path for inflation is uncertain. Overall, inflationary risks have increased since July. Today's forecast has inflation on a higher path than we expected. In addition, rising global tensions are increasing risks. In a more hostile world, energy prices could move up sharply, supply chains could become disrupted again, and all of that could push up inflation again around the world. To be confident that our policy rate is high enough to get inflation back to 2%, we need to see more easing in our measures of core inflation. We remain focused on a number of indicators of underlying inflationary pressures, particularly the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. Les signes que la politique monétaire fonctionne sont
With clearer evidence that monetary policy is working, Governing Council's collective judgment was that we could be patient and hold the policy rate at 5%. We will continue to assess whether monetary policy is sufficiently restrictive to restore price stability, and we will monitor risks closely. Today's decision also reflected our best efforts to balance the risks of over and under tightening. We don't want to cool the economy more than necessary. We don't want Canadians to have to continue to live with elevated inflation either. And we cannot let inflation become entrenched in the economy. If inflationary pressures persist, we are prepared to raise our policy rate further to restore price stability.
With clearer evidence that monetary policy is working, Governing Council's collective judgment was that we could be patient and hold the policy rate at 5%. We will continue to assess whether monetary policy is sufficiently restrictive to restore price stability, and we will monitor risks closely. Today's decision also reflected our best efforts to balance the risks of over and under tightening. We don't want to cool the economy more than necessary, but we don't want Canadians to have to continue to live with elevated inflation either. And we cannot let high inflation become entrenched in the economy. If inflationary pressures persist, we are prepared to raise our policy rate further to restore price stability. We've made a lot of progress, but we're not there yet. We need to stay the course. When price stability is restored, the economy will work better for everyone.
All right, we are going to take you back to the central bank holding a news conference this morning after announcing that it is keeping its key interest rate at 5%. The governor is speaking again. Let's listen in.
We take it into account. It's determined by market factors.
Okay, our next question will come down here to Randy Van Tong Knight from Bloomberg, please.
Hi, Governor. You said you're still prepared to raise rates again if inflationary pressures persist, but what does that look like numerically? What do you need to see happen in the near term to prompt another hike?
So first of all, we decided to hold the policy rate today because we are seeing clear evidence that higher interest rates are slowing the economy, and that's cooling inflation. But we did leave the door open to higher interest rates if needed. To be confident the policy rate is high enough to get inflation back to 2%, we need to see downward momentum in our measures of core inflation. Core inflation on a year-over-year basis has come down, but if you look over the last good 8 months or so, on a 3-month basis, there's really been very little downward momentum. We need to see clear downward momentum in core inflation. And there are a number of indicators that we're watching closely there's a number of indicators of underlying inflation that we're watching closely in that regard. And we've been pretty clear what those are: the balance between demand and supply in the economy, wage growth, corporate pricing behavior, and inflation expectations. We're going to take our decisions one at a time based on the best available data and information at the time of that decision. If inflationary pressures persist, we have been very clear. We're prepared to raise our policy rate further if that's needed.
Thank you. We'll go next to Najoud Al-Maliz from Canadian Press.
Hi, Governor. One of the upside risks outlined in the report is the war and the effect it could have on energy prices. The monetary policy report also touches, I think that one, it touches on essentially how that kind of shock would play out differently right now because of inflation expectations, because of corporate pricing behavior. So I'm wondering, that would be out of your control, a global shock, but I'm wondering how would the Bank of Canada handle something like that, given the inflationary period right now and those dynamics you're concerned about?
Well, 2 points. First of all, we've already built in a higher path for oil prices into the projection that we published. We raised the path for oil prices by about $10 relative to July. So part of that risk is built in. But look, I'm no military expert, but it's clear there are risks that the tension in the Middle East could escalate, and you could see an even bigger increase in prices. So how would we handle that? So, if inflation was at 2% and the economy was reasonably imbalanced and inflation expectations were well anchored on 2% on the 2% target, typically we would tend to largely look through that. And the reason for that is it takes time for monetary policy to work. These increases in oil prices, they tend to go up, and then after a period they tend to come back down. So by the time monetary policy is really working, the shock's gone away. However, that's not the situation we're in right now. Inflation's been above the target for 2 years. Inflation expectations, near-term inflation expectations are still above the target. They're actually even above our own forecast. And as you highlighted, corporate pricing behavior is not normal. What we've seen is companies are passing through higher input costs more quickly than usual to final prices. So consumers are feeling it right away. So against that environment, we would need to be more cautious than normal about seeing through it. And what we'd be particularly focused on is the impacts on core inflation. If we saw evidence that higher energy prices were passing through to broader prices because of higher transportation costs, for example, that would be a signal that that increase in oil prices is starting to feed through to the rest of the economy, and that would really be something of concern to us.
We'll go now to Jordan Gowling from CTV, please.
Hi, Governor. In the NPR, you talk about one of the downside risks. You talk about bond yields not having been this high since before the 2008.
All right. Again, we're listening in to the central bank announcing this morning that it is hitting pause on interest rate hikes in Canada, citing inflationary pressures. Governor Tiff Macklem says he is prepared to raise interest rates again if needed, and says inflation in this country is trending higher than expected, and also notes that global tensions are increasing risk. We should also mention inflation is currently sitting at 3.8% in this country, and it is projected to reach its 2% target by 2025.